Hi, everyone. Anthony Scilipoti here, and I'm joined by my good friend, Darryl McCoubrey.
Glad to be here, Anthony.
It's been a while, and Scott's honest to get these done and just one thing after another. But as I look back here over the past year, it's been incredible. Who would have expected? And, I started out, I put in a seat belt attached to my desk chair. And now I've added some airbags so that we can make sure to deal with all this maddening volatility. But at the same time, our work and the attention to detail and fundamentals have really proven to be the edge here as we look at our performance for the V-list. When we started it back in 2004, and Darryl, maybe you could move to the next slide. It was designed to be a showcase of our top buy ideas as chosen by the selection committee from the best ideas of our analysts. And it's concentrated, equal weighted, bottom up. We choose the names based on their own characteristics, assessing first the downside risk and getting comfortable with upside catalysts. And I know there's some things you want to add there.
Yeah, I mean, the biggest point I think I'd add to it is that the independent research, as we've labeled at the bottom of the slide here, it really does drive the process at Veritas. We try to, give autonomy to our analysts so that they feel free to come up with their best ideas to us. And then we do vetting at the higher level. So there is some acknowledgement of different risks present in different sector, whether it's at the asset level or capital structure. But truthfully, the process pretty much follows the same kind of steps forward to achieve results that we've had thus far.
Yeah. And if we look back over time, you can see over the last 18 years, we've outperformed the index by about 350 basis points. There's been 240 ideas that have been added to the list over that time. And what I think is really important is the low turnover. And we've had names stay on the list for upwards of 13 months on average. And that's testament to the quality of the calls, the time that it takes for fundamentals to play out. And as the next slide will show, when you look over time, the fundamentals do work. This year has been particularly impressive given the negative drawdown that we've had. But if you look over 5 and 10 and 3, and since inception, again, you have that 350 basis point outperformance. And I know that, this has been something that we've discussed a lot as we go back over the 2020 time period, which was the most challenging for all of us. But I know that you had some comments that you made at that time that I think still resonate today.
Well, we didn't have performance numbers like this. There was a time when the market went against us because I don't think our process necessarily gives the same level of confidence in what I would call almost subsidies. Those being, lenient government spending, lower interest rates, etc. That was something that caught us, I think, I wouldn't say off guard, but no, we hadn't priced that in per se in our top picks. And we had some catching up to do. So it's good to have these results in front of us today, just to kind of verify that what we're doing is still going to work over the long term.
And when we think about the sustainability of that, we made a decision that those stimuli that were coming in the form of monetary and fiscal stimulus was unsustainable. And that really leads to our decision process that played out over the last couple of years. And if you look at the next slide, when we look at our portfolio by sector here, you can see that coming through 2021, we reduced our exposure to technology as we believe that inflation was not transitory, that the excesses that were provided by the excess, I think, by the stimuli from central banks largely was not going to be something that was sustainable and would bring down valuations. So we got out of tech completely. We had kept expanded our exposure to the safety, let's call that staples, utilities, cash, and gold. And that's, you can see today sitting at around 40+%. And at the same time, we made two really difficult decisions. And I think, managing money when the markets are going straight up is easy. When markets become volatile, and especially with stronger drawdowns, than upturns, that's when you have to make some difficult decisions. And this year was about those difficult decisions. We started out the year, we said, this is going to be a stock picker's market, and it has become exactly that. And I think, I'll let Darryl describe some of the decisions, especially in the financials and energy side and industrials, that really led to our win here.
Yeah, I mean, there's no real secret. We'll go into a little more detail with the process, but on the ground, how it tends to work is we get good ideas fed up to us by our team of experts, specialists in each of their sectors. And then we have general guiding principles. At the asset level, we want high equity risk premium. We don't want a stock that's trading 100 basis points above its carrying cost of debt. We want a stock that doesn't have non-investment credit. These are just kind of generic things that we'll kind of overlay. But at the end of the day, this is entirely kind of bottom up, fed by our analyst team. And I think that's kind of the key to the success at Veritas, that we don't have much of an overlay kind of on process. There's no boilerplate template here.
Yeah, every decision has to be on its own merits. And just to expand on what I was alluding to, you can see the minimal exposure to financials throughout the year, decreasing as time went on, and as the strong and significant exposure to energy. And that really is something that we believed in. We continue to believe in here. And heading into the next year, I think the decision process is going to be, some of these very beaten up names, where the fundamentals are strong, where the balance sheet is such that it doesn't have near-term debt coming due, and cash flow can sustain if it has a dividend or its operations. Those are going to be names we're going to be looking to peck away at here in the coming 6 to 9 months.
So yeah, the last slide here is just kind of, I think, reiterating our B-list process, because we put this out, I think the last time we did, we also used an example of the energy sector, of kind of how we followed this process. But ultimately, it just comes down to these things. Number one, I keep saying it, we do rely on our analysts a lot, not just on the assets, but also on accounting. And we think the accounting piece of the puzzle is very important for the second part, which is you can't compare core returns across similar assets unless you understand their accounting. The language, how they're communicating the performance of those assets, has to be the same. So that's a big part of what we do. And then we make changes based on risk-adjusted returns. And so this is where there could be a bit of an overlay, because you and I, we tend to be maybe apprehensive towards pricing in subsidies like government intervention and such, and we've been caught with that. But I think with inflation where it is, with kind of austerity creeping into discussions worldwide now, the focus on higher returning stocks that have good balance sheets, it's not going to hurt us in the long run.
That's for sure. All right. Thanks everyone for your support, and we'll see you soon.